Stop for a moment. Not because of noise, not because of hype, but because something rare has just happened inside the institutional financial system, something that almost never becomes visible while it still matters. This isn't a rumor, it isn't a prediction, and it isn't a theory about what might happen someday. This is a coordinated response by large financial institutions to a risk they believe is no longer manageable. And when institutions move together, it's never about opinion. It's about survival. Markets don't usually break loudly. They weaken quietly. Stress builds where most people aren't looking. And by the time headlines catch up, positioning has already changed. What makes this moment unusual isn't price movement. Silver prices go up and down all the time. What's unusual is behavior, specifically institutional behavior. Because when large banks decide that exposure itself is the problem, not direction, not volatility, but exposure, it tells you the structure underneath the market is being questioned. Large banks don't operate emotionally. They don't react to social media narratives or trending opinions. Every major decision goes through layers of risk analysis, compliance review, and internal modeling, especially decisions that affect clients, especially decisions that involve stepping away from an entire market. So when institutions advise exiting silver exposure across the board, that decision didn't come from a single data point. It came from multiple stress signals converging at the same time. Silver occupies a strange position in global markets. On the surface, it trades like a commodity. But beneath that surface, it functions more like a leveraged financial system, layered on top of a relatively small physical base. For years, that imbalance didn't matter. Most participants never wanted delivery. Contracts rolled forward. Confidence did the heavy lifting. But confidence is conditional. When conditions tighten, behavior changes. And right now, the behavior around silver is changing in subtle but important ways. One of the first signs is inventory, not total silver in existence, but silver that is actually registered and available for immediate delivery within the exchange system. This inventory acts as the shock absorber for the paper market. As long as it exists in sufficient quantity, stress can be absorbed quietly. But when that buffer starts shrinking faster than expected, it changes the incentives of everyone involved. As registered inventory declines, a new concern enters the market: availability. Participants who previously treated delivery as irrelevant begin to reassess. Some decide that if they ever want physical certainty, now is the moment to act. That decision increases delivery requests, which drains inventory further. Here's where the first consequence appears. Inventory decline doesn't just reflect stress, it creates it. That stress feeds into counterparty considerations. In calm markets, counterparty risk is invisible. Everyone assumes performance. But in stressed markets, assumptions disappear. Banks begin asking uncomfortable questions about who is exposed, who is short, and who needs liquidity to survive another swing. Silver's derivatives market is particularly sensitive to this because leverage magnifies small disruptions. A relatively modest shortfall in physical availability can ripple outward into margin calls, forced covering, and funding stress. This is not about price direction, it's about system resilience. Institutions track these dynamics constantly. They monitor settlement behavior, delivery ratios, funding conditions, and interbank stress indicators. They don't need a crisis to begin before acting. Their goal is to avoid being present when conditions flip from manageable to unstable. Another important layer is timing. Institutional exits are rarely random. They align with reporting cycles, balance sheet constraints, and internal risk thresholds. When exit guidance includes a time window, it usually means models show probabilities shifting unfavorably beyond that point. This doesn't mean collapse is guaranteed on a specific date. It means uncertainty becomes harder to quantify. And when uncertainty can't be quantified, exposure becomes dangerous. At this stage, behavior starts to cluster. Large players watch each other closely. When one reduces exposure, others reassess. Not out of fear, but out of logic. If a peer with similar data access is stepping away, it's worth asking why. That's how exits begin quietly. And then, suddenly, they're no longer quiet. At this point in the story, it's worth pausing and asking a simple question. If institutions with the most data, the most access, and the most to lose are choosing to step back from silver exposure, do you think they're overreacting or responding to a structural shift most people haven't noticed yet? Share your view in the comments. And if you want these kinds of moves broken down calmly before they become headlines, make sure you're subscribed. Now, let's go one layer deeper, because price action alone can be misleading during periods like this. When institutions exit early, markets don't always collapse immediately. In fact, volatility often increases in both directions. Prices can spike sharply as shorts cover. Prices can fall suddenly as longs liquidate. Both moves can occur in rapid succession. This chaos is not a sign of health, it's a sign of liquidity being withdrawn. Liquidity is what allows markets to function smoothly. When it thins, execution becomes unpredictable. Spreads widen, slippage increases, and small orders begin moving prices more than they should. For institutions, this environment is survivable. They have scale, access, and optionality. For participants relying on leverage, tight stops, or paper exposure without delivery certainty, it becomes dangerous very quickly. This is the next consequence. As liquidity declines, risk becomes asymmetric. Losses accelerate faster than gains. That's why institutional exits matter, even if you disagree with the narrative surrounding them. Markets are not just about being right. They're about remaining solvent long enough for being right to matter. What's happening now isn't about predicting whether silver trades higher or lower tomorrow. It's about questioning whether the mechanisms that have supported paper trading for years can continue absorbing stress without losing credibility. Once credibility cracks, the rules change. And institutions are reacting to that possibility not emotionally, not dramatically, but methodically. Not because they expect immediate failure, but because they recognize that systems don't warn you before they transition. They simply stop behaving the way you expect. That is the risk being priced here. Not speculation, not sentiment, not headlines. Structure. And once structure becomes the concern, exits tend to be early and rarely reversed. As stress builds inside a market, the first thing that breaks is not price, it's assumptions. For years, the silver market functioned on a shared belief that delivery was optional, that leverage was manageable, and that liquidity would always be there when needed. Those assumptions allowed paper claims to multiply far beyond the underlying physical supply. But assumptions only hold in calm environments. When conditions tighten, participants stop asking, "What is the price?" and start asking, "Will this contract be honored?" That shift in mindset is subtle, but it changes everything. One of the earliest signs of this shift is the delivery ratio. In normal conditions, only a small percentage of futures contracts ever result in physical delivery. Most are rolled forward or settled in cash. That's what allows a relatively small physical market to support a much larger financial one. But when uncertainty rises, that ratio changes. More participants choose to stand for delivery, not because they need the metal immediately, but because they want certainty. They want to convert a promise into an asset, and every additional delivery request puts pressure on the system's weakest point. Here's the next consequence most people miss. Delivery demand doesn't need to exceed supply to cause stress, it only needs to approach it. Markets are forward-looking. If participants believe future delivery may become difficult, they act early. That anticipation alone can destabilize the structure. As delivery pressure increases, attention shifts to who is short. Short positions are not inherently dangerous in liquid markets. They provide balance. But in stressed markets, they become focal points of risk. Shorts must deliver or cover. and covering requires buying either paper or physical. When multiple short holders attempt to reduce exposure at the same time, liquidity becomes one-sided. Prices jump not because fundamentals changed, but because exit doors narrowed. This introduces a new dynamic: forced behavior. In calm markets, participants act by choice. In stressed markets, they act by obligation. Margin calls, collateral requirements, and funding constraints dictate decisions. Strategy gives way to survival. Institutions are especially sensitive to this transition because they operate within tightly regulated balance sheet frameworks. When volatility rises, capital requirements rise. When capital requirements rise, tolerance for exposure falls. This creates a feedback effect. Rising stress leads to reduced exposure. Reduced exposure leads to thinner liquidity. Thinner liquidity leads to larger price swings. Larger price swings increase stress. Each step reinforces the next. Now add counterparty risk to the equation. In a derivatives-heavy market, your exposure is only as safe as the weakest participant on the other side. When stress rises, banks monitor not just their own positions, but the health of everyone connected to them. Funding markets, repo activity, credit lines. These are the places where cracks appear first. When banks notice counterparties drawing down liquidity more aggressively, posting weaker collateral, or requesting extensions, it changes how risk is priced internally. Exposure that looked manageable last quarter suddenly looks fragile. This is another reason exits cluster. Banks don't wait to find out who fails first. They reduce interconnectedness before failure occurs. That means stepping away from markets where contagion risk is rising fastest. Silver's structure makes it particularly sensitive to this behavior because it sits at the intersection of commodities, derivatives, and leverage. Stress in one layer quickly transmits to the others. Another important angle here is information asymmetry. Institutions don't have perfect foresight, but they do have better visibility. They see settlement delays. They see unusual funding requests. They see which participants are becoming price-insensitive buyers or sellers. These are early warning signals that never appear in public data until much later. Retail participants usually encounter stress after it manifests in price. Institutions encounter it before, in behavior. This is why institutional exits often appear early or unnecessary to outsiders. They're not reacting to what has happened. They're responding to what becomes likely if trends continue. Probability, not certainty, drives these decisions. As exits accelerate, market-making behavior changes. Dealers widen spreads. They reduce inventory. They become less willing to warehouse risk. This doesn't stop trading, but it changes its character. Price discovery becomes jumpy. Liquidity becomes episodic. Execution quality deteriorates. This is where volatility becomes misleading. Sharp rallies can occur as shorts scramble. Sudden sell-offs can occur as longs liquidate. Neither move resolves the underlying stress. They simply redistribute it. Another consequence emerges here: time becomes compressed. In stable markets, participants have time to adjust. In stressed markets, windows close quickly. Decisions that could have been spread over months are forced into days. That compression amplifies mistakes. Institutions try to avoid being trapped in that phase. That's why early exits matter more than perfect timing. Once too many participants attempt to exit simultaneously, order disappears. What was once a market becomes a scramble. This is also why markets rarely break at obvious extremes. They break during transitions, when narratives are still divided and outcomes feel uncertain. At this stage, public commentary often lags reality. Analysts debate price targets. Commentators argue fundamentals. Meanwhile, institutional behavior has already shifted. This divergence creates confusion for observers. Price moves don't match stories. Stories don't match outcomes. But underneath, the same forces continue working. Declining tolerance for exposure, rising focus on liquidity, and increasing sensitivity to disruption. The most important takeaway from this phase is not what silver does next week. It's that the environment supporting easy participation is changing. Markets don't need to collapse to become dangerous. They only need to become unreliable. And unreliability is exactly what institutions are trying to avoid. As stress accumulates, the system begins leaning more heavily on its final supports. When private risk takers step back, responsibility shifts upward toward exchanges, clearinghouses, and ultimately entities designed to preserve continuity at any cost. That shift is never neutral. It changes incentives, it changes rules, it changes outcomes, and once it begins, it rarely reverses smoothly. Which brings us to the final layer of this story: what happens when markets transition from participant-driven to system-managed, and why that moment reshapes risk far beyond silver itself. When markets reach this stage, control quietly changes hands. At first, markets are driven by participants. Buyers and sellers negotiate risk, price, and timing. Liquidity comes from willingness. Volatility comes from disagreement. This is the healthy phase. But when stress persists and participation retreats, markets stop being participant-driven and start becoming system-managed. That transition is subtle, but it's decisive. As institutions reduce exposure, exchanges and clearinghouses begin carrying more responsibility. Their priority is no longer price discovery, it's continuity. Keeping the system functioning becomes more important than keeping it fair. This is the point where rules start to matter more than fundamentals. Delivery terms get adjusted. Settlement methods are clarified. Margin requirements change. Trading halts become more frequent. These actions aren't designed to punish or reward anyone, they're designed to prevent cascading failure. From the outside, this looks like chaos. From the inside, it's triage. This is why institutions exit before this phase becomes visible. Once markets are system-managed, optionality disappears. You don't choose how to exit, the system chooses for you. Another consequence emerges here that most people underestimate. Price stops being the primary signal. In stressed, system-managed environments, price becomes reactive, not informative. It reflects forced behavior rather than genuine agreement. Spikes and crashes say more about liquidity gaps than about value. That's why relying on charts alone during these phases becomes dangerous. The chart is showing symptoms, not causes. At the same time, divergence accelerates. Paper markets continue functioning because they must. Contracts trade, prices update, but confidence weakens. Physical markets, meanwhile, begin operating on a different logic: availability, access, and trust. This divergence doesn't require a default to matter. It only requires doubt. When participants doubt whether paper claims can be converted into reality on demand, behavior changes permanently. Premiums rise, delivery timelines extend, willingness to part with physical assets declines. This is not panic. It's rational adjustment. Institutions understand this, which is why their exits aren't statements about silver's long-term value. They are statements about risk during transition. Silver can ultimately move much higher. It can also experience sharp sell-offs along the way. Both outcomes are possible. What institutions are avoiding is exposure during the moment structure itself is being renegotiated. Because renegotiation happens under pressure, and under pressure, outcomes favor stability over fairness. This brings us to an uncomfortable truth about financial systems. They are resilient, but not neutral. When stressed, they protect the core first. Peripheral participants absorb the adjustment. This doesn't require conspiracy. It's how complex systems survive. The participants best positioned during these phases are not the most aggressive, but the most flexible. The ones who can wait. The ones who can absorb volatility. The ones who are not forced to act at the worst possible moment. That's why institutions prioritize balance sheet resilience above returns when stress rises. They know opportunities come after transitions, not during them. For everyone else, The challenge is psychological. Periods like this reward patience, preparation, and clarity. They punish urgency, leverage, and certainty. The loudest voices are often the least reliable. The quietest moves are often the most important. What matters now is not guessing the exact path silver will take next week or next month. It's recognizing that the environment supporting easy assumptions is changing. Markets don't announce transitions clearly. They reveal them through behavior. And behavior is already shifting. Institutions are stepping back. Liquidity is thinning. Structure is being questioned. These are not signals to panic, but they are signals to pay attention. Because once markets move fully into system-managed mode, flexibility disappears, decisions become constrained, and those who waited for clarity discover it arrived too late. Preparation in moments like this doesn't look dramatic. It looks cautious. It looks boring. It often looks wrong until suddenly it doesn't. That's why following institutional behavior matters more than following narratives. Institutions don't always get direction right, but they are usually early when structure changes. And structure is what determines who has options and who doesn't. If this breakdown helped you understand why institutions are stepping away, rather than just what they're doing, make sure you're subscribed. These structural shifts don't happen often, but when they do, understanding them early makes all the difference. And share your thoughts in the comments. Do you think markets can smoothly absorb this transition? Or are we already past the point where volatility becomes unavoidable?